We're getting reports out of China, and this is coming from the highest level, that they're on the verge of doing something they've only ever done 4 times in history. Now, I want you to understand the significance of this because this is crisis level protocols. The last time they did this was in 2015. You might remember that China's economy, right alongside the rest of the world, was plunging into a deep recession, and this was a move that was credited with not just saving China's economy, but pulling the entire global economy out of that recession. And I've been warning that they've been faced with doing the unthinkable because so far nothing they've done has worked. And the risks here are high because if this doesn't work, what it means for China is their economy is screwed. But as you're about to see, for the rest of us, it means we're screwed as well. And tonight's show is brought to you by NERP. If you want to unleash explosive wealth, you can use NERP's machine learning trading platform that, get this, it does the trading for you. That's right, it trades for you. Click the link in the description or the pinned comment below to find out how NERP can ignite your portfolio. Now let's turn to Bloomberg because I want you to see what's got the attention of the political elites in China and why I think that this next power move isn't going to work at all. As President Xi signals China may finally move to end deflationary price wars, and what we're finally starting to see is the economic woes in China are reaching the upper echelons of the government. They're starting to get concerned here because what we talked about yesterday is prices are continuing to fall at the producer level in China. This is going to bring consumer prices down, and the risk is, as demand falls, that companies are going to fight for what little business that is out there. They're going to continue to cut costs, and at some level, they're going to start cutting employees. And for China's economy and for every economy around the world, when that happens, well, it means a recession is a foregone conclusion. Now China is looking to make an incredible move. They're going to do the unthinkable that they've only ever done 4 times in history to try to keep their economy from plunging into an all-out crisis. But the path forward is far from clear. Xi's government must curb excess supply without stalling growth or putting jobs at risk, especially as external demand slows and a lasting trade deal with the U.S. remains elusive. And this is something I've been warning about for China's economy for a very long time, that the problem is, as the world's largest exporter, they're heavily dependent on the rest of the world. They just don't have enough internal demand to absorb all of their production. And now we're seeing the world slow down. And the issue is, the biggest issue, and this is not just with China's economy, it's the entire global economy, is excess supply. And we're seeing inventories built at the manufacturing level, wholesale level, and even at the retail level all across the world. At the same time, we're seeing demand go down. And when this happens, well, it means not only are consumer prices going to head down, but it means the unemployment rate for China and the rest of the world is about to go higher. Let's take a look at this chart of retailer inventories against the consumer price index. That one's shown in red, both on a year-over-year rate of change. And this is U.S. data. It really illustrates what's going on in China and the rest of the world, because when you see retail inventories rise, as we're seeing here in red, and they're not absorbed, they're not pushed through, consumers are not buying, what happens is inflation turns down into disinflation, and sometimes, like in the global financial crisis, it turns into all-out deflation. And the problem we have right now is, during the pandemic, we saw inventories get worked through, but after that, what happened? Everyone bought into the narrative that the global economy was going to boom at a new higher level. So production surged, and then we had the trade war, and what happened? Everybody wanted to front run it. And what are we finding out? That there's way too much supply, way too much capacity. And again, this is an issue plaguing China's economy as they start to look for answers, is how do we clear out this inventory? How do we create demand? Because if we don't do it, and don't do it soon, well, what's coming next is mass unemployment. If you're concerned about market volatility, and let's face it, who isn't right now, your portfolio could be missing out on a market-neutral strategy. For decades, large institutions and hedge funds have relied on quantitative trading software to stay ahead, especially during turbulent or uncertain markets. These tools aren't new. What's new is that individual investors are finally getting access. There's a company called NERP, founded by a fund manager, that's bringing these cutting-edge solutions to everyday portfolios. Their algorithmic software is designed to be market-neutral, means not tied to the ups and downs of the S&P or in a single index. It can make a powerful diversification tool. The system is completely completely automated so you don't have to make any of the trading decisions. It scans the markets and executes thousands of trades on your behalf using strategies that are uncorrelated to traditional equities. You're not just riding the market, you're managing risk intelligently while still aiming for long-term performance. It trades in currencies, gold, and crypto, and is designed to compound inside your portfolio without requiring constant oversight or any manual trading. You get back your time and still stay in the game. Setup is straightforward, and NERP offers concierge onboarding, a dedicated account manager, and access to a private user community with strategy updates and live market insights. If you're curious about how this kind of strategy has historically performed or you want to see real results, click the link in the description. NERP is giving early access to my viewers, and I think it's worth a closer look, especially if you're focused on risk management in any market environment. And the evidence is clear as we turn to this chart as we now overlay continued claims in red against retailers' inventory still shown in blue. And you can see what happens when inventory levels get too high and they're not pushed through to the end consumer is demand goes down. And this happens all the way up at the factory level throughout the supply chain where we don't need production, and that leads to people going on the unemployment line. You can clearly see here right around 2022 we get a peak on the year-over-year rate of change in retailer inventories. As it comes down, what happens? You see continued claims go up. Many experts said that the top in claims was in. We've got some updated data on that. What we're saying is due to all the oversupply around the world, we're going to see a lot of people on the unemployment line. For China's economy, this is a worst case scenario that requires them to do something. Again, they've only ever done 4 times in history. If executed right, it could be helpful to global trade in terms of easing tensions coming from China's overcapacity. Again, this is a word we're going to hear a lot of in the years to come. And output spilling into the global markets. But in the short term, it's not GDP friendly. And this is a key point. Why are we seeing interest rates in China plunge? Because it's a function of growth and inflation expectations. So overcapacity leads to falling growth. Well, what are we seeing in their producer prices? We're seeing deflation. What are we seeing in interest rates? They're heading down. And this is what's going to happen in the rest of the world. Just hang tight. You're going to see it flow through. But here's the big one. It's not employment friendly. So it's a balancing act. And that's a problem because the Chinese government now at the highest levels are starting to wake up to the reality of what's happening in their economy, that all the stimulus they've been doing has not worked, just as we said it wouldn't, and now it's creating an even bigger problem. Let's take a look at China's car industry, because what's happening is profit margin is now at a record low. And this is something we're going to see as companies fight for business. They're going to look to drive prices down. And this is a major problem because it's going to impact wages, it's going to impact hours, and as employees make less money and face higher prices, their spending is going to go down. But there's some major risk here, because what it means is not only could businesses find themselves insolvent and closing their doors, it means there's going to be a lot of unemployment. Let's take a look at this chart here of corporate profits after tax. That's shown in blue. We're going to keep continued unemployment claims in red. And what do we notice? Anytime you see decelerations in corporate profits, you can see throughout history there's a corresponding increase in continued unemployment claims. And this is a huge risk, because one thing we know about the tariffs, particularly here in the US, is they're a tax, and they cannot be passed on to employees in terms of higher wages or more hours. For businesses, everybody's been wanting to absorb those prices. There's a huge risk here, because as they do it, and you're seeing this across the supply chain, even happening now in China, that the risk is, as you see profits go down, it means the unemployment rate, or in this case, continued unemployment claims, likely to head a whole lot higher. The People's Bank of China even weighed in on this, expressing similar concerns, naming, quote, prices running at a low level continuously as a key challenge of the economy for the first time in recent years. And this is a huge problem for central banks. They don't like deflation because you can cut rates and it virtually has no impact. It doesn't change things, because when you get deflation, you tend to get rising unemployment. As we've talked about, you can cut rates all you want, but if people don't have a job, they're highly unlikely to go get loans, and even more importantly, unlikely to go out and consume in a big way. In May, the central bank offered another detailed analysis of the downward pressure on prices, which highlighted the limits of relying on monetary easing to reflate the economy under a growth model that's tilted toward investment and supply. So again, you talk about the issues here. Even if the Fed were to cut rates, the problem is you've got all of this inventory, and when you have too much inventory, the problem again comes back to the lack of demand, not just from consumers, but the lack of demand and need for employees. Again, as that starts to fall apart, consumption starts to go away, and then you can find out that monetary policy largely doesn't work. And this is why now we're hearing from the highest levels of the Chinese government, they're facing doing something they've only ever done 4 times in history. Let's take a look. Because China property stocks today erupted on rumors that Beijing may revive the 2015 stimulus playbook. And this was fueled by speculation of an imminent high-level government meeting aimed at reviving the country's struggling real estate sector. Unverified reports suggest Beijing may assemble a policy conference as soon as next week, reminiscent of the 2015 Central Urban Work Conference, which triggered large-scale shantytown redevelopment and infrastructure stimulus. Since the founding of the republic back in 1949, Chinese senior leadership held only 4, quote, urban work conferences at the central government level in 1962, 63, 78, and here you see it in 2015. Thus, if the reports turned out to be true, it would be closely watched by the market given policy direction implications, because what this is suggesting is everything we've been warning about is happening. The Chinese economy is plunging deeper into recession, that all the stimulus that they've done isn't working. They're forced with doing the ultimate here. This is a major bazooka if they pull this trigger, because what they're risking here, if it doesn't work, you have a government that's even loaded up in more debt. But the other side of the story, if they don't do it, we know their economy heads into recession. It pulls the real estate sector right down with it. And because of all the loans the banks have lent to those property developers, it means you have an all-out financial crisis. But we talk about the risks here. If it doesn't work, China's economy heads into recession with an over-indebted government. But it doesn't mean the U.S. and other countries are immune. Because remember, China's demand comes from the rest of the world. And what we're finding out from American consumers, well, this demand is going down even more. As Delta shares jump 11% after airline reinstates its 2025 profit outlook, as CEO says, get this, bookings have stabilized. Now, they haven't improved, and that's a big indicator that we've reached a plateau here. And the problem is, what are we seeing across the economic data? What are we seeing in a lot of these surveys is consumers are worried about their jobs and their spending, meaning that right now in the summer, this is a time where a lot of money gets spent. Well, what happens as we come out of summer, the risks is this plateau is just one step on the next move going down. That's what we're hearing now from the airline industry. What they've done is they've shifted their booking patterns a little bit. They're holding off on making plans until they're a little closer to their travel dates, and so that's shifted some of our bookings and yield management strategies. Now, why would consumers do that? Well, one, they're worried about their incomes and their jobs, so they don't want to commit to something until they're closer to seeing the actual travel date. There's the other side of this. Because there isn't as much demand, there isn't the worry they can't get seats, and this is a problem because we talk about oversupply in China's economy. We're seeing oversupply in the airline industry here. And again, it's all backfeeds to the labor market. And this includes trimming capacity outside of travel periods as they look for surgical cuts after the peak summer travel season ends around mid-August. So what do we now foresee for the U.S. economy? As travel goes down, you're going to see a lot of companies cutting. And when they start to do cutbacks, they're talking about staff levels, because when you start restricting the number of flights, well, obviously you need fewer people to manage them. Corporate travel is also stabilized. Again, what we're not seeing here is growth from the airline industry. And when people have money and when they're optimistic about their jobs, or if employers are optimistic about making deals happen, you see travel go up, particularly with airlines. And we're not seeing that at all. In fact, Delta's total revenue per seat mile fell 4% in the second quarter. Now, 4% isn't a big number, but again, we go back to what's happening in China. They're worried about the fact that companies are seeing their profits go down, and when profits go down at some level, companies start to defend that margin, and they've cut all their other expenses. The next thing you do is start to cut employees. Now, what we're hearing from Delta is we may not see that till mid-August, and that will be here pretty quick. But as we look to the latest weekly data on claims, we can get some suggestion it may start to happen for a lot of other people in the coming weeks. As U.S. jobless claims have now fallen for a 4th week during the July 4th holiday. Initial claims only decreased by 5,000 to 227,000 the week ending July 5th, and that remains at a relatively low level historically. But it's not the initial claims we're worried about, because one thing we do know is employers right now want to hold on to the employees, and it is the summer season, so there is some hope that perhaps the economy will turn around here a bit. The risk is it's continued claims. It's people who are already unemployed. And what have we been hearing from people who do have a job? That they're a little more optimistic that they're going to keep their job for a while, but if they lost their job, they're worried about getting another one, and for good reason. Because continued claims, a proxy for the number of people receiving benefits, has now risen to 1.97 million. Remember, my line in the sand is 2 million. I think if it breaks over that, we're in big trouble. Still the highest since late 2021. But as we've been talking about, the risks are if we don't see a decline in continued claims, initial claims are going to shoot a whole lot higher. Here's the evidence. Let's take a look at this chart of initial claims in blue against continued claims still in red. And you can see where continued claims go, initial claims eventually follow. You can see this happening in every recession. And the risk here is we haven't seen that because employers are holding on to employees as long as they can. The problem is for those they do lay off, they find out that there's little to no opportunity to re-enter the workforce. And as their spending goes down, remember, the longer they're on unemployment, the less money they spend. As that starts to feed through the economy, and perhaps we'll start seeing it really impact a lot of things around mid-August. Watch out. What you're going to see is employers who are going to be forced to defend their profit margins have to lay people off. They really have no option here because unlike China, the U.S. government really doesn't have the ability to unleash a massive stimulus package. The decline in initial claims suggests employers are reticent to let go of workers, but the ongoing rise in continued claims indicates how difficult it is for out-of-work Americans to find a job. And we're finally starting to see that the mainstream media is really waking up to the reality here is that the labor market isn't anywhere near as strong as the Fed has been claiming it is. And this again is a problem because, as I've said, the longer people stay on continued claims, the higher the probability is their lack of demand in the economy is going to lead to other workers seeing their hours cut, their jobs cut, and the next thing you know, they're right on the unemployment line and we're spiraling out of control. But if you think the Fed's going to do anything, well, it doesn't appear they're going to do anything just yet. As the recent Fed minutes show, policymakers split on how tariffs might impact inflation. And keep in mind, the Fed minutes are very important because what we hear at the press release is the Fed saying what is happening right at the time. But they listen to the response from the media and the Wall Street, and then they make some tweaks. And then it's published as what we call the Fed minutes. Let's take a deeper look here. While a few participants noted that the tariffs would lead to a one-time increase in prices, it would not affect longer-term inflation expectations. Most participants noted that the risk that tariffs could have more persistent effects on inflation. And that is absolutely baffling to me. The idea that you could have a one-time tariff lead to persistently high inflation, well, what that would imply is that tariffs would lead to an increase in demand. What are we seeing today? It doesn't matter what country we're in. We're seeing this happen all across the board, particularly in the services sector. They raise prices, demand goes down. So we know this is likely to be a one-time shock to the economy. Why the policymakers don't get it, I don't know. And most economists expect tariffs to drive up inflation and weigh on economic growth. And that's absolutely correct because, again, we see prices go up, demand goes down, and that means inflation will eventually come down. We might get a transitory shock to it, just like we saw during the global financial crisis, but it's unlikely to last. Fed Chair Jerome Powell said the central bank probably would have lowered rates further this year if not for tariffs because, again, what they want to do is they want to constrict demand. Again, at a time, what are we seeing in the labor market and the global economy? We're seeing demand slow, and the Fed says, look, it's not enough. We really want to restrict demand some more. Wrong move, Fed. You got this one wrong. But economic data has so far not shown a broad-based impact from the duties, although it's likely we might see something in the coming months, which is opening a debate among policymakers over when, how much, and for how long tariffs will ultimately boost prices. The problem we're seeing here is perhaps the demand is falling fast enough, and that is an issue that is offsetting the rise in tariffs. But as far as what China's about to do, if they do unleash this massive stimulus bazooka, the reason I don't think it's going to work, and the reason I want to show you this U.S. data from Delta, is what we're seeing, not just from American consumers, but from consumers all around the world, that they cannot afford higher prices, demand slowing down, the labor market's weakening, and no matter what China does, the odds of it working and boosting consumer confidence where they're going to go out and spend, in my book, I don't think it's going to work at all. We'll find out soon enough. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.